My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is Lyn Alden. Lyn, for those who don't know who you are and have never been on social media or heard a single podcast, introduce yourself. Who are you? What's your background? What have you done throughout your career? What are you doing currently?
First of all, thanks for having me. My background is a blend of engineering and finance. And so I initially was an engineer, eventually became an engineering manager, running the finances of an engineering facility. I eventually shifted to basically applying that kind of systems analysis to macro analysis. So understanding how markets work, how money systems work. And so that's been my focus for quite a while. I provide research at enlightening.com. I wrote Broken Money, and I also do work with Ego to the Capital, which is venture investing.
So I'm looking at some of the reviews on the book, and kudos to you. I mean, you've obviously struck a nerve in the way that you wrote it and the way that people are responding to it. Lyn Alden offers a brilliant and unique perspective on the evolution of money. Read this book, you'll get valuable insights, interesting book with lots of knowledge. One of the best books I've ever read, which is going to be hard to top if you're going to do a sophomore book after this. But I am curious, Lyn, so it's not easy to write a book, and I think I saw that post from you. It's also not one that's typically profitable. What made you want to write this book? And talk about how that's different in terms of writing a book versus writing research and articles that you do for your service.
Right. So I've written a lot of long form articles, kind of known for the length of some of my articles. And there's enough content over the years. An easy thing to do would be to package that into a book, but I didn't really find value in that approach for my work. Instead, I kind of resisted writing a book for a while because the editing process is very long. The time to reward ratio for the author's perspective is not great. It's just not something you do for money. It's something you do when you feel like when you can't not write a book, like when there's a certain calling that's kind of pulling you towards the book. And so that eventually struck me mainly because a couple key themes kind of coalesced. The book kind of formed in my head. And what I generally find when I'm writing about money is that every time I write an article, part of why they end up being so long is that I want to establish a bunch of things first, like kind of first principles up to what is the topic we're talking about in money in that article. And so I eventually just found that this is something that ideally needs a book. It's something that money is one of the most important things in the world. How money systems work, who controls the money, what are the traits of good money? What happens if you have bad money? How some of those things can be opaque and you don't even realize they're happening. And so I wanted to have that kind of very long deep dive into it to help people kind of from first principles understand it. And in a way that my angle of it was through the lens of technology. That's something that I don't see explored enough. You'll see the history of money explored through the lens of politics. What were key decisions that, affected monetary systems? Whereas I focused more on, the steps along the way that affect what people can use as money and what are the traits of good money and how can money be moved or abstracted or de-abstracted. And so basically I feel that the money is a big enough problem worldwide for a lot of people. And yet it's one of the problems that they least understand and that is hard to understand, opaque to understand. And so for me, writing a book that actually kind of just goes from start to finish on the whole kind of history of money from my perspective is just something that I felt that was important to do, something I got a lot of kind of just mental reward for doing, even though it's like I said, you should never really write a book for the sake of profit because there's usually other things you could be doing that have better ROI for your time.
The line that I've often heard is that writing a book is like having a very expensive business card that just takes a lot of effort to put out there. I am curious, I've got to assume that you went through a whole bunch of different reference book materials and things like that in terms of, as you were writing along the way, doing research, aside from what you already knew. What types of resources did you look towards as maybe filling in holes in terms of the way you yourself might have understood the way money works once you started putting the book together?
So I was lucky. I had an editor reach out named Joachim Book, and he has degree in monetary history from Oxford and is also an editor. So that was very useful for helping me with citations and fact checking and bringing other things to my attention. Some of the key things I found useful were to explore some of the early divergences in monetary theory. So the commodity theory of money is well covered, and separately, the credit theory of money gets coverage. They rarely tend to get coverage in the same book, though. They're often these two very siloed ways of thinking. And so I would dive into theorists in both camps. Those are very useful. And then the other one that was kind of a surprise hit from a research perspective, like a lot of fruit came out of that, was William Stanley Jevons' 1875 Money and the Mechanism of Exchange. The reason it was useful is because that was the earlier part of the international gold standard. So in 1871, at the end of the Franco-Prussian War, there was an era of peace across Europe. There was widespread telegraph installations over the past, decade or so, very sophisticated paper banking instruments, cross-Atlantic connections to the United States. And so that was the international gold standard period. And it was interesting reading the perspective of someone analyzing it as though it's new technology, because it was at the time. And so that book was basically the version of Broken Money from 1875, in the sense that he starts off exploring the history of money, what money is, and then how just the technology of money changes. And then he's analyzing the current system. And he's saying, okay, this is, in one hand, it's super efficient. Like, there's so much money changing hands, and gold hardly ever has to move because of how hyper efficient this all is. And we just keep centralizing it more and more towards London. And basically it's so much stuff can move around and it's super efficient. But on the other hand, he's like, this could be catastrophic because this whole system's levered 20 to 1. If 5% of people want their gold back at any one time, the system doesn't have that. And a lot of bankers don't really seem to be treating it like that. And so he's like, I can imagine this could be a disaster by being almost too efficient and abstracted. And of course, that's what happened in World War I. So it's kind of interesting. And it was actually one of the later resources I came across in my research, which is that I was thinking about how to make that chapter 8 a little bit more kind of impactful, because it was an important chapter part of the book, but it was one that wasn't really kind of coming out as strong as I would have liked. And finding that resource, I thought, really helped bring that. It kind of illustrated the whole point with examples and historical context, and was kind of the missing ingredient I needed for that chapter. So that was one of my favorite resources to come across.
I feel like we need to define what broken means in the context of money, because, that's a term that everyone's like, yeah, of course money is broken, but I don't know if that's actually properly defined. How do you define what broken money actually is?
Well, I think in the broad term, it's just money that does not work for people the way that they would think it. So I open the book by saying, I kind of list out some of the problems of money right in the introduction. Kind of before I get into the history of money, the whole first section is to say, what's the current state of money? Like, why is this book being written? And I just kind of give off this huge list of, this country hyperinflated in our lifetime. This other country hyperinflated in our lifetime. This country's been dealing with double-digit inflation for a decade straight. This other one just cut their currency in half relative to the dollar, which they did, 6 years prior again. And that forces everyone to readjust, very quickly. And just inflation happens to them outside of their control. They don't know why. So one is just the fact that money's been very weird lately. I mean, negative yielding bond, there was $18 trillion with negative yielding bonds. Why is that happening? Why is there so much debt accumulation? So some of it is just the broad sense of, why is something as simple as money, which the whole point is to facilitate trade and be simple? Why is it so complex? And why is the track record so bad compared to other industries? That's number one. And then more specifically, it's the idea that technology itself has been in this local maximum for a period of time, where not only was it broken, there's really no way it couldn't be broken given the state of technology available, right? So basically, in the telecommunications age, when gold is not fast enough to keep up without being abstracted, that abstraction leads to arbitrage, leads to centralization, leads to corruption. And so it's inevitable that many jurisdictions would end up having very bad money. So it's really that kind of two-phase approach of just, one is that money's bad, but then two, it's bad in a way that, at least until maybe recent technologies, it couldn't not be bad. And it was kind of like an exploration of the tragedy of why is money so bad for billions of people in the world.
Is there a correlation between how broken money is and the depth of a wealth gap, meaning the wideness of a wealth gap? Because you use that word corruption. And I think when people think about the wealth gap widening, there's the natural inclination to think that, well, the wealth gap is widening because of corruption.
Well, yeah, I think that there is a big correlation, and a lot of it has to do with opaqueness, right? So if a government entity is funding itself with taxation and bond issuance, that's at least a transparent way to finance itself. Whereas if it's financing itself in large part due to currency dilution, it's basically extracting savings from people without them necessarily being aware. So taxes can be imposed on people against their will, but at least they're transparent. Whereas if inflation is imposed on you against your will and it's not even transparent, that has all sorts of extra ethical issues. And so what we generally see in the world is that because of the state of money, it is siloed. So the whole point of money is to be a common unit that people can use to trade. But we have like 160 plus currencies in the world. Each one is kind of enforced on its own jurisdiction and has little or no acceptance outside of its jurisdiction, except for, the top few of them. And so basically that gives a lot of the controlling power structures the ability to just kind of keep their citizens almost like in a matrix of dilution. Like it's just so ingrained as how the system works because there's not really been an alternatives. And so you see, for example, with the IMF, Alex Gladstein's work has covered this really well, which is basically that, a lot of these countries will build up external debt. They have to get refinancing. They get kind of, deals. And a lot of times the leaders are themselves, extracting money off the top for themselves. They're buying foreign properties. They're holding money in foreign bank accounts. So they're not kind of stuck with their own dilution. And what they instead do is they keep diluting their own people's currency. And there's even a lot of times that's imposed on them by the IMF. So I think there's multiple layers of corruption around the world as it relates to money. But at the end of the day, kind of the result is that people are in these currency bubbles, for lack of a better word, and they're just constantly getting diluted. And until fairly recently, there's not really been much of a solution. They can protect their savings with assets, but at the same time, their assets locally could be very limited in terms of what assets they can even select, especially if they want to have liquid assets. And two, it still doesn't solve the problem of wages. So if you're trying to negotiate wages every year in an environment of double-digit inflation or periodic spikes of double-digit inflation, as billions of people deal with, it's a constant uphill battle just to retain your ongoing purchasing power, let alone your savings. And so that's a topic that I view as kind of one of the biggest corruption or kind of one of the biggest downsides of the current system in a world where a lot of other things have gone very well. I mean, there's been energy abundance, there's been technology abundance. There's all sorts of things that are making lives better around the world. And money is just really not one of them. And so that's kind of the low-hanging fruit for things that clearly need disruption and fixing.
When you look historically at just the history of civilization in general, was there a particular period where money was least broken, where there was, comparatively a lot less corruption, any kind of historical time period where it's like, all right, that was maybe a model to look at?
I think the two models of relevance, one would be kind of the dawn of the Renaissance. The financial systems that were being built out of Northern Italy were, they kind of fueled a lot of the innovation that happened. Basically, when you had a sound monetary foundation, when you had increasing usage of banking technology and then eventually the printing press, that was a useful period for money. That was a burst of innovation. The classic gold standard was how, Britain became a world power and then the United States became a world power. I mean, they rose to prominence when they had sound money. And as I discussed previously with Jevons' analysis, money and the mechanism of exchange, like the system was not perfect back then. It was highly levered, for example. But for that era, it was working well enough. So there's never been a platonic ideal of money. In many ways, banking is the ever-present struggle of trying to make money better, kind of overcoming the natural limitations of money, kind of the gold coin divisibility problems or transportation problems or verification problems. It's all these layers of abstraction to try to kind of deal with the fact that money is just not perfect. But those eras, kind of the 1800s and then going back, the Renaissance, were periods where money was certainly better than average.
And how do you think about the interplay to debt in a system? I'm going to assume that an anti-fragile system where money is not broken lends itself towards having some natural limitations as far as how much leverage there can be.
Yeah, generally what we see is that certain types of money encourage more debts than other types of money. And ironically, really hard monies and really bad monies, neither of them tend to build up too much debt, whereas the medium money tend to build up the most. And what I mean by that is, like, if you look at an emerging market with a constant inflation, they tend not to have very high debt because there's not that many lenders that want to lend in a unit of account that they don't know what's going to look like a year from now, let alone 5 years from now. On the other hand, if you have very kind of hard money and there's no kind of entity that can just create more of it on the spot, whenever there is a banking crisis, usually the leverage gets kind of pulled down closer to that monetary base. Whereas what we see in the modern era with kind of our medium money, like if you look at the dollar or parts of the gold standard that were centralized and fractional reserve, you'd have, whenever there's a banking crisis, you can increase the amount of base money in the system to kind of retroactively make that leverage money good. So you basically kind of start locking in inflation as part of the system. And so there's certain monies that just inherently accumulate debt. And then those have consequences, right? So monies that are very credit oriented, like our modern times, they give a ton of kind of wealth concentration potential towards those who have access to that credit. And so, for example, when you see a country that has high levels of inflation, high levels of poverty, low levels of banking access, it's the poor that are suffering under inflation more because they're, using cash. They're not earning interest on their cash. They're getting inflated away constantly. Meanwhile, the upper classes have more investment options. They have access to credit cards where they can pay 30 days later. They have various ways to kind of short the currency to, say, buy a property, for example. The use of credit is basically a way of shorting the currency. And so these environments they help facilitate wealth concentration. And that's not to say that wealth concentration can't happen in sound money environments. That's, the Gilded Age was known for that. But generally what we see in the current times is that more inflationary areas tend to have more wealth concentration because the divergence between how the wealthy can handle that and how the poor can handle that is very large.
Right. And actually, that's where I think it gets to be really interesting in terms of where we are now. It's where is the money being funneled to, right? It's getting more and more concentrated, not just in terms of companies versus individuals, in terms of large caps versus everything else, in terms of rich versus poor. To me, when I think about broken money, it's more about the transmission mechanism that's broken the most.
I think that the underlying money itself determines what the transmission mechanisms are going to be. So I would say it's deeper than just the transmission mechanism. And it actually kind of goes back to the central theme of my book is like who controls the money. So some monies are very hard to control. Other ones are fully centralized. And so the fact that pretty much by necessity in the telecommunications age until recently, money had to be kind of centralized in order to keep up. But that gives tremendous power to those who have that centralization. And so it's kind of been a series of rug pulls globally for a century now. And that is something that is, I think it's been a very deep technological problem. So a lot of people will focus on the moral aspects of it and say, if only we had done this differently, or only if we had done that differently. But when you see something happening worldwide to varying degrees, that's something that's more inherent than that. And I think basically going back to that phrasing of a local maximum, like we've been stuck in this kind of local maximum of money where we have very fast transmission mechanisms for payments, but we didn't really have like a sound underlying unit that could move around without being abstracted. And that just leads itself to tremendous arbitrage and corruption and opaqueness. And I think that opaqueness is really a big part of it because, people don't like taxes, but it's even worse. Imagine like a tax that's not even transparent. Like you don't even know what your tax rate is, but it's just happening anyway. That's inflation. So it's like it's the worst of all worlds. And it's something that it's very hard for people to detect or measure the size of when it's happening to them.
So you have that people say every fiat system dies, every form of money eventually dies. I've got to assume though that there's a link between longevity of money staying broken and things like military might, military strength. Is there any relationship to, sort of more autocratic governments to the life, how long a broken money system can last? And even if it's not autocratic in the case of the US?
Well, so generally speaking, when you have some level of decentralization with money, like you have different divisions of powers that have to affect what's going to happen, that can prolong the longevity of it. Also, the bigger the network effect, the bigger the economy that it's tied to, whether or not there are alternatives can all affect how long it lasts.
Okay, so I do want to transition a little bit to the current market environment. There is this line out there that what's happened with treasuries is because of bond vigilantes and a buyer strike when it comes to duration. I have my own thoughts on that. I am skeptical of a lot of things that you hear about when it comes to the bond market because I think it's classic narrative following price. But I do want to get your take on, I know you're more of a long-term thinker with this stuff, but I am curious about your kind of short intermediate thoughts on the speed with which we've seen the yield curve move, and in particular how duration is sold off.
Well, the way I keep describing it is I've been a bond bear for a number of years now, but the speed and the scale of this bond bear market has been surprising even to me. And in large part, that's because of where we're starting from. Like we basically had the dot-com bubble of bonds. Like when you go back and look at the dot-com bubble, the valuations were insane. And that's why you could have such a big, sharp drawdown when it finally happened. And with bonds over the 5 years before the kind of the pandemic stimulus and in the early parts of it, you had negative, $18 trillion worth of negative yielding bonds. You had a decade of kind of zero rates, negative real rates kind of across the developed world. And so you're starting from nosebleed valuations. Like if you think of yield is, kind of the inverse of price. So bond prices were at just absolutely historically, all-time high levels. And so it only takes a small amount of inflation or trend change or large fiscal deficits to pop what was a very large bubble. And so I think what we've been seeing recently is just huge amounts of supply coming to market. We've seen fiscal dominance over monetary dominance, which basically means that it's not just bank lending that kind of leads to money creation. It's large monetized fiscal deficits that we've seen over the past few years. And so there's been a huge recalibration in the bond market, which then has ongoing issues because these deficits, especially in the United States, are still unresolved. So it's just a fire hose of supply coming to market. And then ironically, the higher that those yields go, that contributes to more supply happening because it increases the interest expense of the government. And so whenever you have a feedback loop like that, it's just very powerful. And it just started from such a highly valued position that it's been a remarkable kind of historic bond bear market.
I do think it's important to differentiate though between a duration bear market and a credit bear market. I will say it very clearly from my vantage point. I'm actually bond bearish too, but I'm bond bearish on the credit side, not so much on the kind of flight to safety treasury side. I put out that post before. I saw on CNBC somebody was saying, whether that's a question of yields peaked. And to me, it's not about yield peaking. To me, it's more about the flight to safety trade bottoming, which is the idea that credit spreads start to widen. How do you think about credit risk? Because I think that's, if there's going to be another phase, what I call phase 2, corporate credit risk, that seems to be what's still to come.
Yeah, I mean, we over the past few years where I've been bearish on treasuries, credit's always more cyclical. So for example, obviously, the whole pandemic era was very bad for credit. Then there's been a rebound. I think in terms of credit, I'm neutral. I don't have a firmly bearish view, but it's also not an area that I find super exciting. I think it's one of those things where you have to be very specific about the industry that you're looking into. So I think there's, at this time, with the yields as high as they are, there are a lot of kind of areas in the credit market because you can get decent yields for low durations, but there is a lot of propensity for that spread to widen because they are on the lower end. And so credit's just not an area that I have had a firm opinion on. What we're watching play out, I think, is the tension between fiscal policy and monetary policy. So as monetary policy tries to essentially cause, something akin to a mild recession to slow things down, that's being offset by the fire hose of fiscal policy, which is stimulatory at these deficit levels. And then you have that weird interplay between them where tighter monetary policy can actually add to the fiscal deficit, which is stimulatory. And so that's been this kind of twilight zone for credit, which is that the recession or the potential recession keeps getting pushed off because monetary policy is partially being offset by fiscal policy. And then it's just a matter of just how industry specific you go. So there's some areas that are very interest rate sensitive and other ones that are not at all.
Let me reset the room. If anybody you want to come up and ask questions, again, click that bottom left mic request button. This will be in podcast under Lead Lag Live on all your favorite platforms, Apple, YouTube, Spotify. Please, folks, help me keep that momentum going. I do this as a way of helping people get out of their echo chambers and obviously to keep content going. Okay, so I'm with you on all that. I think the question that one of the audience members want to ask is, what do you think about the next 6 to 12 months? It does seem like the risk is real that we're going to have a recession. I keep going back to It's on the uninversion when typically that's the sign that a recession is either starting or it's imminent. Do you think this time is different in terms of that signaling power, with the caveat that no signal is ever 100% accurate?
So the challenge with that signal is that when you look at most instances of the yield curve uninversion signal, it happens because the economy's been slowing down and the Fed begins cutting. And so the signal is kind of a self-fulfilling prophecy that basically the recession's already materializing, and so the Fed's cutting. Whereas the kind of the close levels of uninversion we're seeing now, and I really focus on the 10-year, 3-month, not some of the other curves. That's the one that has the most historic literature associated with it. But the partial uninversion we've been seeing in recently because of the sell-off in duration has not been because the front end's going down. It's because the long end's going up, which is different than most other yield curve uninversion signals. So I'd be hesitant to read into too much to it that in that way, just because it's not quite the same signal, even though it is the yield curve inverting and then potentially, depending on what part of the curve you're looking at, uninverting. More broadly, I think that we can find help by studying how emerging markets go through recessions, because when a developing country has inflation and goes through something akin to a recession, it's kind of an emerging market style recession, which is that recessions can be quite different than the ones we've been accustomed to over the past, 3+ decades in the United States and Europe. And I think that's just a model we want to keep looking at, because while recession risk is real, it's with a backdrop of very large fiscal deficits, still above target inflation, the risk for energy security, energy prices, overall kind of just tightness on the supply side. And that's just a different environment than, say, the past 2 or 3 recessions. So commodity mining in general, putting Bitcoin aside for a second, is just a really rough business. Commodities in general tend to outperform their producers, ironically. Like if you look at the history of gold miners versus gold itself, it's been better in absolute terms just to be in gold compared to the mining averages. So you're basically taking on more risk for less return. Now, the reason people do it is because the top decile or so of gold miners tend to capture kind of most of the returns. They know how to manage the cycles well. Basically, that it's an industry that is very kind of skill oriented from the top. And so Bitcoin mining has a lot of similar characteristics in the sense that it's by most metrics, it's not a very attractive business. It's very cyclical. It's hard to differentiate yourself. You're mining something for which you don't control the price. That's why commodity producers are such kind of rough businesses. The interesting thing about Bitcoin miners is that there are kind of 2 big things that kind of go against each other. So on one hand, as you point out, when you reach a certain size, you do get a certain economy of scale that's helpful. But on the other hand, we've not really seen Bitcoin miners get too big as a percentage of the network. Even the biggest ones have generally kind of hit a ceiling around 5% or so of the network. And in this past cycle, some of the very biggest ones are the ones that went bankrupt. And so it's not been one where kind of the biggest miners are over cycle after cycle, the same biggest miners. There's been a lot of churn, which is bad for the miners, but it's good for a decentralized network. Part of the competing with that, so on one hand, there is the economy of scale. On the other hand, a key input for Bitcoin mining is low cost energy. And the lowest cost energy of all, basically free, is stranded energy. So various types of energy for which there's just, there's an energy source, but it's just not near people, or it's just otherwise unavailable. Maybe there's a hydro dam and there's just not enough people around it. And so there's all this curtailed hydro, or it could be in Texas where you have like a closed grid and you have tons of solar and wind. And so you have a lot of like periods of negative energy pricing, things like that. And so miners can go and exploit those. And for many types of stranded energy, the smaller ones are better because, except for those grid stabilization ones, stranded energy tends to come in smaller pockets. And so far there's not really been like a super strong network effect moat in the industry, which I think is a good thing. And so it's probably healthy for the network that Bitcoin mining is a scrappy business that has a high failure rate, because that helps keep it decentralized. But at the same time, if someone is careful and skilled and focuses on it, they can make a living doing it. And it's something worth, a lot of people find value in pursuing it.
Is it fair to say that the spoiler alert on broken money is Bitcoin? I mean, I know that's a big part of obviously your own way of thinking about things, but How does Bitcoin play into the book?
So Bitcoin shows up in the final third of the book. And it, out of the kind of available things I think are in front of us, I think Bitcoin is by far the most promising. It's basically, the way I frame it is that the past century and a half in the post-telegraph era have been a problem where transactions can occur at the speed of light, but gold itself is too slow. And so we get on these centralized ledgers instead. And what Bitcoin represents is the invention of settlements that can move as quickly or nearly as quickly as transactions. So we've sped up settlements. And so you can send money to someone quickly and globally without relying on credit, which is a new feature in the post-Bitcoin world. And then because money is a network effect good, and because decentralization is a key factor, we've had almost 15 years of this industry. Bitcoin remains the largest, most liquid, most decentralized one. The other topic that I focus on in the book is stablecoins, because they allow one jurisdiction and their assets to pierce into other jurisdictions. And so even though they're centralized, these central hubs are in countries that are outside of whatever country might be having a currency crisis. And so, for example, right now, as it often does, Argentina is going through a currency crisis, and you'll see very high levels of, say, stablecoin adoption because it's a way for them to get dollars. So the Bitcoin is what I view as kind of the most optimistic long-term scenario for what can unbreak some of the money situations. But along the way, there are other things as well. And I explore in the book, okay, what's Bitcoin doing? What are stablecoins doing? What are central bank digital currencies trying to do? And it's kind of run through the gamut of things that are happening now that this technology is unleashed and directions it can go in. And yes, I have a pretty favorable view of Bitcoin, obviously. Well, one thing I'd point out is that money transmission is different than the underlying money itself. And so as the case with all major fiat currencies today, the quantity of money itself is in large part determined by a handful of officials. So part of it is determined by bank lending practices, which are themselves highly influenced by central bank activities. But then the base money themselves are directly in the control of central banks and governments. And so not just the monetary transmission, but also just the underlying. And then more specifically, when we imagine on what scope are we looking at centralization or decentralization? So for example, if you're in a country, let's say Nigeria, for example, Nigeria has control over what banks are allowed to send money out to, what money can be sent in. They basically have a lock on their region, as does any country. And so within any given region, even the transmission of money can be centralized. That's why a lot of countries will turn to capital controls in order to protect their currency from, stronger currencies that exist out there. So I would say that I disagree with the idea that money is decentralized as is. It's centralized both in terms of the quantity of the money, as well as on a jurisdiction by jurisdiction basis, even control over money transmission itself. So usually when very large public debts appear, so when debt kind of moves from the private sector up to the public sector, which is the case that we're in now, and previously it was the case in like the 40s, there tends to be some sort of, I think the euphemism would be a recapitalization. So reset, kind of a loaded word these days because it has a lot of different connotations. Recapitalization is basically what governments turn to when they find themselves with so much debt, which is that, if you're an emerging market and you can't print the debt, you default, you restructure. Or if you're a country that kind of prints, you define your own unit, then you generally increase the number of units significantly so that your debt is devalued relative to the number of units that exist. There's obviously a lot of political ramifications when they do that. It hurts some people. It helps other people. It usually comes along with capital controls, because if they're going to do that, then they try to keep people from fleeing to other types of money. And so it's a messy environment. And generally in these prior recapitalization cycles, a new money would be or new monetary structure would be shifted to. So you'd go from, say, the classical gold standard to the Bretton Woods system. Then you go from the Bretton Woods system to the kind of the modern, Eurodollar system. And so I think that in the decades ahead, central banks, we can kind of divide it into two worlds. One is a world where Bitcoin doesn't exist. And in that scenario, they would probably try to recapitalize themselves with gold. That's actually an action that's in the Fed handbook. It's something that the Treasury can direct them to do. They can basically reprice official gold. And it's one of the few ways where the government can create money without creating a debt associated with it. But that would obviously be a geopolitically awkward and important event if it were to occur. And other central banks can do similar. Now, in a world where Bitcoin exists, then the game theories all change now, because whatever best laid plans that central banks might have had, now there's an environment where not only can Bitcoin pierce jurisdictions, but things like stablecoins can pierce jurisdictions. And so instead of having 160 different, mostly closed currency silos, now there's more openings. And so it's harder for those silos to obtain a lock on basically the issuance of currency. Because, for example, if there's an Argentinian graphic designer and they do work for my website, I can pay them in whatever money they prefer, whether it's Bitcoin, whether it's stable coins. I can, they can send me a string of numbers and I can send that value to them. A QR code over a video call could send it. It can just go around their banking system. And so that's the world we live in going forward. And so weaker jurisdictions, I think, are going to have an increasingly hard time maintaining their currencies. And then even the bigger ones, as they go through these very large sovereign debt issues, it sounds extreme to say, but it's an environment they've not really been in since the 40s. And so we should expect unprecedented outcomes. And this is a world where they can try to recapitalize themselves with gold, but at the same time, Bitcoin is this growing network effect globally. And just as I said, other things too, the stable coins and just overall ways to kind of pierce the borders of money. So jurisdictions historically there's two main ways to bring money in or out of a jurisdiction. One is physically through ports of entry. Obviously, they have a lot of control over those. And then the other one is bank wires. And obviously, they have a lot of control over those. But now, in this modern era, peer-to-peer, over email, over video calls, over text messages, money can be sent in a way that's just way more it perforates all those borders. And so that's a new world that I think central bankers and governments are going to spend years and decades dealing with. As long as the internet exists, that's just something that exists now. That's technology that exists. Now, the big question is, how do the major powers deal with that? So Argentina can't do anything about the fact that the dollar exists, the stable coins exist, Bitcoin exists, and can pierce into their jurisdiction more easily than prior technologies could, or just any other country in that kind of similar situation. Now, for the big powers, I think we're still going to see how that plays out. How does the United States deal with this? How does China deal with this? That's the big period of uncertainty. And so, basically, I think anyone who claims to have too much knowledge of the future, you should just be skeptical of them, because this is an unusual time. It's a big changeover in a lot of different ways, and there's always going to be curveballs. Yeah, it's a good question. And it shows the challenge of network effects, right? So they're going into the dollar network effect and the depth of the capital markets. And so, for example, if Brazil, or let's say if India and Russia make a trade deal and India buys a lot of oil with rupees, the question is, what is Russia going to do with all those rupees, right? So are they going to reinvest it all into Indian markets? Are they going to switch it over into gold? And so the problem is that when they have these different currency blocks, these different economies trying to network together, one is they generally don't want to give over sovereignty of their currency. So there's been a lot of resistance internally to do a shared currency. And two, when they instead do these peer-to-peer routes, which are the more successful method, they still run into frictions of what do you do with all the accumulated capital on one side? Because you don't have this, you don't have this like asset that is, globally accepted and the depth of capital markets you can reinvest it into. And so you see kind of more and more frictions along the lines. If you Google, for example, Russia and India and some of their oil trades, there's been frictions there, and that comes up elsewhere as well. So I think that we are going to see more and more multipolar world. We're going to see more and more decentralization in that regard, but it's a very strong uphill battle when you're competing with a network effect.
Everybody, please make sure you follow Lyn Alden if you don't already, and follow me, as long as you don't mind some occasional cursing and some very loud, sarcastic posts. I will have this again as a podcast under Lead Lag Live on Apple, YouTube, and Spotify. I do continue to believe that the next week or two are extraordinarily high risk based on the market analysis that I myself do. But as Lyn correctly said, nobody can predict the future, not me, not you, not her, not anybody. This is always a game of conditions, and conditions also play into broken money, I'd argue. So we'll do another question to Lyn very shortly, and certainly appreciate those that have been a part of this conversation. I try to run this more like a live podcast, as many of you can probably tell, rather than the more traditional free-for-all dynamics that you hear on Spaces, often from people that don't know what the fuck they're actually talking about. All right, so Lyn, I got one last question on my end I want to ask you. So I'm Egyptian myself, and I know you've been to Egypt not too long ago. First of all, just to talk about the trip, I'm curious. I have not been to Egypt since I was like 3 years old, so I wouldn't have anything to really compare it against.
So my husband's originally from Egypt. And so we go to Egypt every year as our second home because we have friends and family there. And so we live most of the time in the US and we live part of time in Egypt. And so for me, it's not a vacation necessarily. It's just the second place that I live. And it was very instructive for writing Broken Money because it's one thing to research different areas from a monetary perspective, like a developed versus an emerging market. It's another thing to live there for a period of time and to know people there and to talk to them and to have a boots on the ground perspective on the details that you can miss if you're just an economist kind of, just surveying the map and the global financial system and having your theories. And so generally what you see in Egypt is, for one thing, it's obviously the history of it is tremendous. There's many things you can go to, all sorts of stuff like that. What I tend to focus on after the first few times of going and seeing some of the historic sites is just basically living there and getting to know the people and watching how people deal with, kind of constant inflation, weak capital markets that they can invest into. And so one of the things I've been kind of emphasizing lately is that when people hear like super high inflation, they assume things are in complete disarray, whereas people are very scrappy. They find innovative ways to get by and to mitigate things. And so, when I went this time, they're dealing with a much worse financial crisis than they have been in recent years. They have 37% inflation officially. I think it's actually a little higher in the couple months. They're probably about to devalue their currency again and spike that up higher. But for example, when you look around, it didn't really look any different and people weren't really behaving that differently than they were the year prior or the year prior to that. Now, obviously, that's going to differ somewhat depending on what social section of society you're looking at. But it just shows that as bad as money can be, people still find a way to do the commerce they need to do. They find a way to live on with their lives. But at the same time, it shows us just like you're in this country, there's 100 million people. It's just got tremendous history. At the time, a leading empire. And now it's in a diminished form. And I would say it's in large part because it's very hard for people there to accumulate liquid capital, to make very good business decisions. And a lot of it is, not all of it, but a lot of it is tied to this effect I mentioned before, which is that the current state of technology allows 160 different currency bubbles. And those currency bubbles can be managed well, they can be managed poorly. Some things can hit them that are outside of their control. And so people just are in this dilution matrix where every year money supply grows by 20%. And not only do they have to figure out how to protect their savings from that, they also have to figure out how to, if they're running a small business, how do you adjust prices like that? If you're working for someone else, how do you secure a 20% raise to try to keep up with the fact that, money is significantly being diluted over time? And then of course, there's curveballs where Egypt will try to hold the peg steady for a few years. And so it seems like inflation is lower than it is because in some ways it is. They're depleting reserves or taking other actions instead of just letting the inflation run hot. But then people get kind of like a false sense that things are okay. And then they all get rug pulled at once with a big currency devaluation. And so it's just been very instructive for my monetary research to kind of see hands-on what it's like.
Bitkallam Arabi?
What was that?
Do you speak Arabic? I was saying that in Arabic. Bitkallam Arabi.
No, I know some words, but it's been an ongoing thing where every single year I go, my husband's always like, okay, next time, he's going to teach me and I'm going to know how to speak it. And I always promise that I'll know next time, but I'm always so busy that I never am able to learn. And so instead, I know a handful of words, but otherwise I'm just fortunate that the people I know there all speak English.
Lyn, for those who want to track more of your work and get more access to your thoughts, where
.com for my research and public writings, and check out Broken Money on Amazon. Thank you for having me.
Appreciate everybody joining. Please make sure you follow Lyn. Thank you, Lyn. Appreciate it.